socials here. All right. Let's get this party started. Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I'll be your host. And today I'm joined with Phil Weiss. Hey, Phil.
Hey, Kirk. How are you on this fine Friday?
I'm doing great. This is a perfect fall day. It's in the 40s. It's crisp. The leaves everywhere. Looking out my new window, which I'm excited about. And you got yellows and reds and greens and browns and purples. It's awesome. I love it. This is a great time of year in New England.
I do too. And it's funny. Earlier this week, I was out in Boulder for our client's wedding, and her parents are old friends of mine that live in Tucson. And in Boulder, they have leaves are changing. Like I don't think I've ever seen anybody more impressed or more amazed, or whatever the word is, by seeing leaves that have changed than somebody that lives in Tucson, right? Because there are no trees, there is no leaves changing or any of that, because the trees that are in Tucson are going up like Mount Lemon, and those are pine trees, and they don't have the color change. So they were just so in awe, I guess is the best way to put it, of the leaves changing colors on the trees are. And I mean, and they were really pretty, I will say that, but it was just a much stronger reaction than I'm used to, and I guess that's what happened when you don't see that on a regular basis.
Yeah, I have to say it's a little weird. I was in, when was it? I want to say it was 15 years ago, 10 years ago. We used to go down to Florida for the holidays to visit family. And it was so weird. You're in like Miami in Christmas and New Year's, and there's like Christmas trees, sort of, and wreaths, sort of. But you don't have the pine, you don't have the traditional like Christmas stuff. You had basically palm trees with stuff on them. It was the weirdest thing I've ever seen, and it was like 85 degrees. It felt wrong. It just felt wrong. Like it's just. And I grew up in the New England, so I'm used to the season changes. I love the season changes. There's nothing like it, but it's not for everybody. You know, it's like when I was talking about Boston. You either love it or you hate it. If you love it, you love it. You're going to stay here forever. If you hate it, you move away, because some people just don't love it. I understand. I love it because the change is what brings, the spice of life, if you will. Because if it's California every day, well, that would suck. Like if it's perfect so I went out. So when I graduated college, I went out to San Diego, visiting a friend for 2 weeks. Stayed at his place, and he was, doing various things. He used to work for a software company. He was a doorman at a popular bar at night, and he had his stuff wired. Anyway, so I go out there and visit him. We're hanging out, and close to the end of the 2 weeks, I wanted to go home because it was literally perfect every single day. And by the end, it was like, this feels weird. Like I'm not enjoying it because it's perfect every day. So you don't appreciate the perfection of it. And it was like, I need change. I need a rainstorm, something. And it was just perfect every day. And I know that's weird, but there's something to change that makes you appreciate the good times, because they're not there every day. But when they're there every day, you don't appreciate it because it's just there. So it's like appreciating that the sun's out. It's like, yeah, sun comes out every day, but so I don't appreciate it. But yeah, I don't know. That's just my 2 cents. But
I'll tell you, if you go in Colorado, you get much more variety. When we were in Boulder, I think on Sunday, temperatures got into the 70s. And on Monday, the day of the wedding, the high was just over 50, and that night it was freezing. And I know I have a friend that lives out in Denver, and he tells me we think about the bad weather, and they do get bad weather. And they get a lot of snow because it's so crazy, because it'll be snow one day, and the next day it'll be 60, and the snow will just all melt. So they have a lot of change even within the season. It's very different than what we're used to, where yes, we have the change of seasons, but the seasons, for the most part, it's similar during the season, although you can have snow or you can have rain or whatever mixed in, but temperature-wise, it's kinda steady throughout the season. In Colorado, places like that, you have a lot more variety. And even when I lived in Tucson for a while, you just had big variation from the morning to the night, because the desert air is so much thinner, so you would have a much wider spread between the high and lows in the day. You're muted, Kurt. Kurt.
Oh, sorry about that. Yeah, that's also weird to me. It's like Arizona, it's like 110 during the day and it's like 30 degrees at night. Like I just find that really odd in the desert, but I understand why. It just feels wrong. Um, you know, so I don't know. It's to each their own, right? You live in your place, and hopefully you appreciate it and enjoy it. And if you don't, you move somewhere else. So
Yeah.
um, anyway, let's get some real stuff. Lots going on, and the last week has been a little weird for some people. Um, I think it was two Fridays ago that Trump came out with his tariff tantrum again, where 100% tariffs, and then walked it back days later. Well, lots happened since then, and I'm not sure we'll get the true story, but from what I've heard, he walked it back. But at the same time, under the guise of that big news, we had a huge sell-off in crypto, in lots of different crypto, where I think Bitcoin is down like 19%. I think I heard. I didn't follow because it's after hours, but a lot of other coins were also down a lot. And so what I found fascinating is that, and I don't know if this was doctored or not, because the way I understood it, it sounded like it was orchestrated by someone where and by the way, if you're thinking it's Trump, I'm telling you that banks do this all the time to each other. So it could be anybody. Banks notoriously will do this, and they'll do it to each other. They're like sharks, and they're trying to take bites out of each other. So it doesn't really matter who it was. Just know that it happened. And what happened is you had a lot of people who had sell orders, like stop loss orders, and basically somebody came in and put a bunch of shorts on and just cleaned it down. And with the news, it just dropped and it hit all of these stop losses. And once it was done, then it bounced back up shortly thereafter. Now, when you see this stuff, you should just be aware that this is how markets work. I'm not saying it's right or wrong. There's a whole bunch of things that I think are wrong in the markets, but they happen anyway. And you know what? It's part of the game. You just got to grow up and get used to it. And so if it happened to you, too bad, so sad, learn from it, come back, and don't make the mistake again. It's just the reality of markets. And the crypto market is 24/7. So you probably should be used to this by now. In the regular stock market, there's controls to keep that from happening, but not here. So I think the thing to think about is when volatility happens, you should have your antenna up and say, what am I missing? Like, what's going on? What's under the surface? Where are the opportunities? Because if you're aware, you could say, well, crypto's down 19%. Like, let me just go grab it. Let me just go grab some myself. So those opportunities exist. So what I would suggest is that there's going to be a lot more opportunities. It's not the only one. There will be more. And so when you're thinking about investing, what you should be doing is trying to figure out, what do I want to invest in? And then have your antenna up for opportunities. So for example, we had, what was it? Let me bring it up here. We had gold and silver. I'm gonna have to go do this on the fly. So we had gold and silver in the last week or week and a half drop significantly. So let's pull up the gold chart here, and you audio viewers can play along. But let's see. That's not what I wanted. Stop. Let's see. Screen share. Here we go. All right. So here is the gold price for the last whatever, the last year and a half. And so if you look here, gold kind of went up to 4,400 and then dropped to, looks like just above 4,000. Well, if you're looking to buy gold, this is a great opportunity. Then does it mean you go all in? That's up to you, but it's a good opportunity to get in because this doesn't always happen. Now, it could mean there's further sell-off, or it could mean it's a great buying opportunity. Now, you can obviously see there's people buying the dip. Now, I wouldn't say I went all in, but I definitely added to my position because I think gold has a good long-term thesis. And I think the long-term thesis is much higher than this. It's not going to happen tomorrow. I think we went way past what it should have happened this year. I mean, if you look at this year, it started at around 2,600 and now it's at 4,100. That's way past what we should have done. So I think gold is if you kind of look at a return to the median, right? If you think of like, all right, let's say hypothetically gold goes up 20% a year. Well, if in 1 year it goes up 40%, then the next year it might go up 0 and it balances out at 20% a year. So if you think about it from that lens, and I don't know what the number is for gold, but I know that the destination's a lot higher and I'm okay for holding. I think it's going to be, 6 to 8,000 probably, maybe even more. It depends what happens. But I do think we're trending in that direction. I don't have a number I'm targeting, but it is in that range. And so when we get to that range, I have to reassess and say what's happening. But for the moment, I'm looking at this and saying, great, if it went down more under 4,000, now I have to reassess, all right, has the trend changed? And then do I have to wait, or how do I invest in these in this asset? So the way I look at it is, all right, there's obviously some volatility. We had predicted this. Doug and I in the last few weeks have been predicting this. And we predicted their volatility in October because there usually is. And we have another week of October, plus we have probably another week or two in November that are also potentially weak. But November, December, January are really strong months in the market. So the question is gold going to keep going higher, or is it going to take a break? Now, if you look at this trend chart, you'll see gold goes up, then it takes a break. It took a break this year from April until August. If you look back, if you look back here, gold went up and then it took a break from 2020, about July, until March of 2024, and then took off again. So it does take breaks, and that's okay. Like, I'm not trading this like a day trader. I'm buying this for long stretches. So yeah, it could take another break for a few years, and that's okay. I'm okay with that. Some people won't like it. They'll say, well, what are you doing? I'm like, I think the trend is higher, and that's what I'm sticking with. If you look at silver, silver's got similar dynamics, right? If you look here for the last few years, silver went up in 2020, and then it's pretty much gone sideways until early 24. And then it started to take off. And then this year, right around July, it just took off from 33 and went up to like 50, 54, just under 54. Now it's trading 48. Now, if you look at silver, it's come off and people are freaking out. Oh, we got to sell it. I don't think it'll keep continuing higher at the same pace, but it's okay, right? Same thing. It's a good time to add to your position. It may go down again, may hit back to 40, but I'm okay with that, right? Because using this example, as I invest, I'm either adding or taking stuff off the table depending on my thesis. So if I think long-term thesis, gold and silver are good bets, then I would add to it on pullbacks. If I think that it's overblown and it's just going to come back down, then I would be selling it on the way up, right? So, silver goes from the high 30s into the low 50s. Well, I would be selling positions on the way up. I'm taking my profits off the table. So when it sells off, hey, I made my profit, I can move on. But I'm not looking at this as a trade. So just something to think about. I'm using this as an example because people are freaking out. They're like, what should we do? What should we do? I'm just like, just relax. That's what you should do. You should relax. If you look at things like cryptocurrency, it also sold off a little bit. But you know what? It's within the range. This is Bitcoin. It's not really doing very much. So should you be freaking out? Not really. Well, it's up to you if you're freaking out. But I would say you don't need to. I think system is terrible. Same thing with Ethereum. Yeah, it sold off a little bit, but it's still within a range. So I think the thing to think about is when you're looking at investing in the hot areas, and in this case, we're talking about, precious metals and cryptocurrencies. That's no different from the Mag 7 for like the last 10 years. So when you're investing in a hot area, there's going to be times where it pulls back and freaks people out and tries to bounce people off the ride. And if you've got weak hands, as they call them, like weak hands, you're going to get bounced out. And if you have strong hands, usually strong hands are people that buy at a lower price. So, if gold dropped 20% today and then bounced back up and you bought it when it was down 20, well, you got strong hands because you got 20% margin to play with. It would have to go down a lot for you to get bounced out. So they talk about in the crypto community, diamond hands. Those are people with strong hands. It's just that you have a different name for it. But strong hands and weak hands are basically based on your strength of your conviction plus the price that you bought it at. So if you bought it in early October thinking it was going to keep going higher, well, hopefully you were listening to the show and you took a little profits because we pretty much said it was going to be volatile. I don't know what it looks like. It's actually been a lot less volatile this month than I would have thought. I would have thought we'd have a lot more volatility, but it's just been okay. So I don't know, Phil, what are you seeing out there?
The concept that you're raising is such an important one in general, that when you find an asset that you like, whether it be a stock, whether it be a commodity, whatever it is, it's important to pay attention to what's going on with it. And if you really like it, look for opportunities to buy it on pullbacks. And just when you do that, just make sure that whatever you understand what made it pull back. Like I'll tell you, I'm not going to name the company, but the most successful investment I made was a stock that I purchased because there were stories about that its management had come from a competitor and had taken their technology, and the other competitor was suing them. And I looked at what I could find on it, and I didn't believe that there was a real case. And I bought that stock, and today it's up between 35 and 40 times because I still hold it, what I originally purchased it for. And I bought it for a couple clients at other times since when it pulled back, because when I bought it, I didn't have clients. It was before I launched my firm. But it's just an important part of investing is when you look for asset, when you're thinking about buying something, make sure you're paying attention and when those pullbacks happen, because they're inevitable, like look at any stock or any commodity, whatever it is, and look at the range between the 52-week high and the 52-week low. And it's usually pretty wide. A lot of times it's more than 100% of the current price. They move a lot. And that means that there were opportunities to buy at those low prices. Just like when it gets too high, you have to think about if you're going to sell. But if you're a long-term investor, like Kirk was saying, that means usually you're not going to sell just because of a pullback. You're going to look for opportunities to buy more. I know that the Motley Fool, I wrote for them for a while. One of the most successful guys there, he talks about not buying on pullbacks, but he wants to buy things that are going higher and continue to go higher. And that's how they bought stocks like Nvidia a long time ago and have held them for many, many years. You buy them and you can add as they go up. But it's always good to look for opportunities in any stock and understand what the story is. And the other thing is avoid confirmation bias and don't just listen to people that agree with the same point of view that you have. Try to understand what the other side is so that if it does pull back, you have a good understanding of whether or not that's an opportunity to buy more. It's an opportunity to just sit and wait until you learn a little bit more, or if it means that you should get out.
Yeah, I couldn't agree more. I think you need to be thoughtful about how you invest, what you're, how you get in, how you get out. Investing's complicated. It's not simple. And we all try to make it simple. We all talk about, oh, it's easy. You just buy and hold. And like, it's not that simple. There are positions that I buy and hold for long periods of time, and there are positions that I trade. And some positions I do both. Like for instance, silver. We have like gold and silver are more or less permanent positions in our portfolio. It's a question of allocation. So if they're off, if they're going sideways, we might hold like 4%. If they're going higher, we might go a lot higher. We had a guy in the show who had 25% of his portfolio in gold. Not sure I'd go that high, but depends what's happening. So when it's off, you just lower the percentage. And when it's on, you increase it. But I still have gold because the thesis is strong. Now, if the thesis was done, I'd get out. But the thing to think about is we all think of the world in a binary way. We think of black or white, yes or no, on or off, in or out. But it's really not. Like silver, we have a permanent position, but then we had some options that are a temporary position. Options are by nature temporary. So we had the trade. Worked out. we got in, worked out, we got out, and we'll wait till silver goes higher and we might jump back in. But we use options as a limited risk because we know, like, hey, this thing's gone up, is ripped this year, and I don't know if it'll keep going. Maybe it will, but it seems a bit ahead of its skis. So I would only add beyond where we are with options, because if I'm wrong, it's like, oh, you'll lose 1%, not like 20%. So that's why options are great, because they limit your risk. But a lot's changed in this month, and it's freaking some people out. And frankly, I don't even think it's that bad. So I'm going to show you a few charts here. So this one I thought was interesting. It just shows percentage of S&P stocks above 200-day and 50-day, percentage of stocks above 200 but not 50-day, and then stocks below 250-day. So when it's green, that's good. When it's red, it's bad. So if you look here, the red's picking up, the yellow's picking up, and it just means that the market's showing a little weakness. But when green's big, that's a good thing, right? So I think it's important to kind of look through these once in a while. We talk about small caps. There's some really big opportunities in small caps, and micro caps. They've done very well this year. I don't know if that'll continue, but it looks to me like, hey, things are breaking out, and I want to be watching this. Now, just like everything else, it is pulled back with this volatility. But if you look at, let's see if I can find it. Well, I'll have to come back to it. But if you look at the market as a whole, the market's kind of pulled back. So it didn't keep going. It's bouncing around. It's had some good days and bad days, but it's basically going sideways. And that's the thing to understand. I don't know if today it's up because we had good CPI numbers and earnings this week, so that's good. But the market's not as up as I would have thought with good earnings. You had big tech this week. Phil's going to talk about that in a second. And you'd think that the market would be up more, but it's not. In large part because this is a weak month. And a lot of people know that. It's no secret. And it's something to keep in mind. I also want to point out some things that I thought were pretty interesting. One of them is this chart that I saw, and it was economic profit from companies. It is so much higher in the last 5 years than it's been historically. So the last 5 years, corporations have record profits. And so when you see things like tariffs, you'd say, well, they're making lots of money. It's going to hit the consumer. Yeah, but they can afford to take a hit. And many of them are, because at the end of the day, who knows how permanent the tariffs are going to be. So many of them are taken on the chin. That's okay. But that will impact earnings season at some point. Maybe not right away, but there will be a time where it impacts it. I saw this chart. I thought it was interesting. Bad year for stock pickers. 22% of active funds beat the market. So it just kind of looks at the trend, the range. So it doesn't matter that they're not beating, it's the range. And so this has been a weird year. I guess if you're an index hugger, it's fine. But if I had to guess why this is the case, it's because people are investing in the Mag 7, and they have not done particularly well this year. They've done okay, but not like in the past. If you look back in like 21, 22, you could just put all your money in NVIDIA and Meta and Google and all these Mag 7 stocks, and you just ride it up. 1 year NVIDIA was up like 100% in a year. That's just crazy. But that happened. So, when you see charts like this, and I bring this chart up because it's a pseudo chart crime, and it's also just a sign of like what's going on. So I look at things and say, oh, isn't that interesting? It doesn't mean anything to me, but I look at it and say, well, why would this be the case? And why is it the case? Well, it's because there's a lot of rotation going on. People have been accustomed to just investing in the Mag 7 and just, buy and hope it goes higher. But in the last few years, actually, value stocks have done a lot better, especially in the last 12 months. If you look at like smoking stocks and companies like that, they've just gone a lot higher. I think it was, what was the stock we looked at? It was like Walmart. Let's see if I can bring this up. I had to, because it was crazy, because I looked at it a few weeks ago and I shared it in the show, and I was just shocked at how much it went up, because it shouldn't have, but it did. And so, it doesn't matter what it should or shouldn't do, but here we go. So here's Walmart. Come on. My computer's not liking me right now. Okay. So here's Walmart. Look at that. It went from like $40 back in 23. Now it's up to like 106. So you pretty much had from 24 to 2024. It went from $50 up to close to $100 in a year. It's Walmart. It's not Nvidia. It's not AI.com. This is like one of the largest companies in the world, and it went up like 100% a year. I saw this last year. I was like, what the hell? What did I miss? What happened? And so my point isn't go out and put it on Walmart. I think you missed the boat on that one. I think the point is that when you're looking at things like this, you need to be aware of what's going on. Are you investing in things, in the right things? No, last year people underperformed. Well, it's probably because they didn't have Walmart, right? It went up 100%. If you didn't have Walmart, I don't know what percentage of the S&P 500 is in Walmart, but you obviously didn't have enough of it, right? When Nvidia went up 100%, you didn't have enough of it. But that's a part of the S&P. So if you look at the aggregate of 500 stocks, it's not 1/500th each. Apple has the biggest share, and then you have Microsoft and so on and so forth down the chain of the largest, and Nvidia is up there too. You look at those big stocks, and how they do dictates the rest of the index. It's like 25% of the index comes from a handful of stocks. So if those do well, you do great, but you better be in them if you're trying to outperform the index. I don't personally care about the index. Index doesn't matter to me. I'm not comparing myself against the index. I'm comparing myself against the markets, because sometimes the index is skewed. And if I'm not big into Mag 7, well, okay, whatever, it outperformed me. But did I do well in comparison to what I think I should be doing? That's what matters. So, because there could be a bad year where the index is down and you're like up 5 and you're like, all right, I did well, right? But it just depends on your goal. And I think that's really the point of this is what is your goal? Is your goal to mirror the index, or is it to manage risk, or is it to crank out 7% a year? Whatever the goal is, there's a strategy for that. And, we help with that with clients, but it's basically comes down to, you need to have a goal with your investing. You need to understand what you're trying to accomplish. And most people don't. Most people just like, roll the dice. Let's see what happens. What do we got? Roll hard 7. I know that's not a thing, but anyway. So what are your thoughts, Phil?
A couple of things. I want to go, if I think about those two charts that you showed there, there's another connection you could potentially make too. The one that showed like the number of stocks that are trading above the 200-day, and then how few stock pickers have been successful. When fewer stocks are above their averages, the market's not as broad either. And I'm not just talking about, I know the Mag 7 occupies such a big part of the market, but you also have the fact that when less stocks are outperforming, it gets harder to beat, because it's hard to put all your eggs in one basket. Like, you can tell me that the Mag 7 are 25-30% of the market, however much they are, but it's still hard to put 25 to 30% of your portfolio, unless you're just going with an index, to have such big positions in those stocks when they've done really well. Because we've talked about diversification, and remember, the S&P is market cap weighted. It's not, there's an equal weight version, and the performance of the equal weight version of the S&P is very different than the market cap weighted version. But when fewer stocks are outperforming, it's harder to be a successful stock picker, because one of the ways to be a successful stock picker is to deviate from the market, right? To look for, where is it that I think I can do better than the market? And that's usually not going to be the companies that that are the largest. You're going to look for other areas to be in. So that's just something that I want to keep in mind. And market performance varies. Like, I have a new client that I got recently, and he's talking about things that he didn't want to invest in or was hesitant. And one of the ones that he listed was international stocks. And I understand why. But it was interesting because I think that international should be part of a diversified portfolio. So I looked at some data. And if you look over the last 12 months and the year to date, a developed market ETF and a broad developed market international ETF and a diversified emerging markets ETF has soundly beaten the S&P 500 over the last 12 months as well as year to date. And you can go through other periods. Like I looked at a period, I created another chart where I just compared developed international markets to the S&P 500. If you go from like 1997 to 2010, international outperformed the S&P, but since then it hasn't. So it all depends on the period, and different things can do well at different times. And that's just something to keep in mind when you're thinking about constructing a portfolio. That's one of the reasons that we think about diversified portfolios, because the bottom line is we don't know. We have no idea, right? I always tell people the crystal ball that I have, it's cracked and it's cloudy. So it doesn't tell me a whole hell of a lot. So it's better. And when I think about it from a client perspective, we're not trying to beat the market, right? Because that's really hard to do. I mean, you saw that chart, 22% this year, and even the high end that was 60, and that's an unusual number. It's hard, and the longer you look, it's really hard to beat the market. The goal to me is to construct a portfolio that you can live with in terms of the risk that it has, and that allows you to live the life that you want. The last call I ever want to make to a client is to say, hey, remember that big trip that you had planned? It was your bucket list trip. You were so looking forward to it. Well, we made this investment and it went south and we underperformed the market dramatically. And now we have to reevaluate. And I don't think you can do that anymore. That's a call I never want to make. So you have to think about it that way too. It's not necessarily about trying to beat the market, because when you try to beat the market, you're usually taking on more risk. And if we take on too much risk, when the market goes south, usually that means we're going to do worse. And so you want to try to avoid those situations too. You want to think about what it is that you need. We try to match kind of your portfolio allocation to your risk tolerance and what you need in your plan.
Don't let Phil fool you. Phil knows what's going to happen in the future. He knows. He just doesn't want to say it. I know too, by the way. All financial advisors know what's going to happen in the future. That's why you hire us, because we know what's going to happen in the future.
Yes.
So don't let Phil fool you. So anyway, I want to share this chart because I saw it and I thought it was funny. So this is a chart that's showing non-profitable tech stocks to the S&P. So there's been a trend since May of non-profitable tech stocks doing extraordinarily well. So pretty much since April, May, non-profitable tech stocks are up like 100%, and the S&P is up 35%. Now, I'm not sure. Actually, no, that's not true. This is the percentage. I actually don't know what this is measuring, because there's no way that's true. The S&P is up 35%. Actually, it could be, actually, you know what? I think that might be accurate, because if you look at the bottom where this is like the bottom of the tariffs,
April, April
yeah,
8th,
if you look at April, this might have been, yeah. So I think from the bottom, it's probably, so this is accurate. So from the bottom, these things are up 100%. The S&P is up 35. That is not true. The S&P is up like 15% for the year, but the market sold off like 20%. So that's how you get to 35. But I just want to show the contrast. And here's another chart. Let's see if I can find it. There was a great chart here that showed the dramatic effect of non-profitable tech stocks. So here's another one. High quality stocks underperform, or they've underperformed since 99 is extremes. So if you look here, if you look at 99, the underperformance was negative 11%. So they basically value stocks, high quality stocks underperformed, .com, no earning stocks. And then you contrast that to like the end of 2000 in December, and the high quality stocks outperformed by like 20%. So, those are the extremes. But look at it now. If you look at 2010, quality stocks beat the market. That was like the only time. But if you look at it now, it's the low quality stocks outperform the quality stocks by like 10% this year. It's crazy. It's like, it's not the lowest, but we're getting there. So now when you see this, you're probably thinking, oh my God, we're at a peak. It's a bubble. It's going to pop. Yeah. I look at it and say, isn't that interesting? Because when I say, isn't that interesting? It doesn't say, I know the future, or I know what's going to happen, or we're in a bubble and it's going to pop. Yes, we're in a bubble, but it doesn't mean it's going to pop today. It could pop 10 years from now. I mean, I've been saying it's a bubble for the last 10 years and it hasn't popped. So it could be another 10 years. We don't know. But the point is it's an isn't that interesting event where you can say, okay, maybe I should be looking at a contrast to that. Maybe I should be looking at quality stocks as a potential place to invest. And we are looking at that. And, we haven't found our next Walmart that goes up 100% a year, but I'm sure there's some out there. I actually know there's a few out there. There's quite a few. And there's not enough because that's not the market we're in. But we've seen over the last 2 years some value stocks really take off. And that to me has been very interesting because there's a lot of stocks that have big corporations that are earning good earnings that haven't moved like in a few years. They're just going sideways, even though they're growing. So just something to keep in mind. I think all of these things are really interesting. Here's another one I found funny. Roundhill Investments launched the meme fund, the meme ETF. So they launched it in 2021 because of all the meme stocks. So they're like, all right, let's take advantage of that. And they're smart, right? Doing that. And then they shut it down 2023 because the meme stock craze was over. And then they just relaunched it. So I think it's an indication that you should pay attention. So one thing that I noticed, and I don't have the chart up, but there was a ETF called the coal ETF, and I think it was VanEck. I'm not 100% sure, but I think VanEck did it. And VanEck had this coal ETF, and the symbol was KOL. And I remember because I was following it. I track a lot of these things, and so I remember that coal was in the toilet for a long time. It looked like this. It went down and it was just in the toilet. No one was interested in it. And it was the green energy boom. And where coal's dead. No one's ever going to use coal again. So what happens? At the very bottom, it was like right here, like right at the very bottom of the market in coal, they shut the ETF. You know what happened? This. Like this next leg is what happened as soon as they shut it. So I have this thing in the back of my head that anytime they shut something, it's a great time to get into that area because it means everyone has just ignored it and they're just like, ugh, I don't want to touch this. It's disgusting. That's when you buy because there's no one in it. No, there's no one left to sell. And that's the key. You want to buy things when there's no one left to sell. That means the only way to go is up. Now, if you're buying at the top, when there's no one left to buy, that's when markets go down. So you work in both directions, right? And I'm not saying, buying at the bottom and selling at the top is hard. I'm not saying it's easy, but you want to look for these kind of things. So if you think you should invest in meme stocks and they just launched the fund, I'd say, okay, well, maybe I'll wait until they close it. Maybe that's a better time to buy them, or maybe not at all. In my case, I would not buy meme stocks. I think it's just, I think it's for the pikers, the people at home sitting in front of roaring kitty and trying to follow along. That's great for you, but I mean, I can't. That's irresponsible for me to do that.
Isn't that a lot like what happens with stocks that exit the S&P 500? I don't have the numbers, but I know that I've seen data that says stocks that get taken out of the S&P 500 do really well. It's the same kind of thing, right? Because you think about it, when a stock's going to be added, it runs up in price because all the index managers have to buy it to get it into their portfolio. And the stocks that are coming out, they go down. And that's oftentimes a good opportunity to buy them because now the sellers are done. So that's when you can step in, and if those are still reasonably good companies, there's an opportunity for them to go up from there. So it's the same kind of phenomenon. I know it's funny you mentioned meme stocks because my son came in before and we were talking about, and this is now a meme stock, Beyond Meat, which is a stock. I want to say that it was 100 and something, maybe even $200 at one point. It was down to 50 cents. Now it's a meme stock and it went up. It's like a couple dollars now, but that's a huge increase from 50% because now it's become a meme stock.
Yeah, I mean, Beyond Meat, that's a great example of a company that shouldn't have gone public, but the people who took it public, good job on you for cashing out at the top and letting everyone else hold the bag. And this is one of the problems with IPOs is people get excited, they want in, and the stock ends up going nowhere because it's basically just a meme stock. It's a short-term trend. It's like buying a cannabis company and hoping it's going to go to the moon. It's like, no, cannabis is a weed. I can grow weeds in my yard. There's no barriers to entry to growing cannabis. There's nothing you're going to do that's like, wow, look at the weed company. You know what it sounds like? It sounds like a tobacco company. And you know what? There's no small cap tobacco companies. They're all owned by the big guys. So I from the beginning, I never touched that, and I'm glad I didn't. And people are like, yeah, but cannabis is low. I'm like, good, then go smoke it, because that's the only value you're going to get from cannabis stocks. But we had some earnings. I don't know if you want to talk about earnings. I have this chart up, Phil, but I think this is a good kind of perspective for where things fall within ranges. So I don't know if you want to talk about earnings. Like, what are your thoughts on earnings this season? Like, what have you been seeing? Like, what are you scoping out?
They've been good so far. I know I was reading, I get research from Ed Yardeni, and it was talking about, I guess this was through Wednesday or Thursday, the data said that the number of companies that are beating on earnings and revenue, I mean, that's normally the case because companies tend to want to underpromise and overdeliver, and so they will try to set their expectations low. But the number of companies that beat earnings and revenue estimates so far is higher than it was last quarter, and it's higher than the historical average. So in general, we've had a pretty good earnings season so far, and that's one of the things. If you look at the market last week and this week, it's been pretty good and investors are happy with the way earnings are coming. The financials were last week. We've had a number of other companies in different sectors this week. I mean, I know Netflix disappointed, but I thought that the Netflix miss, from what I heard, they had a Brazilian tax charge that they had disclosed. There was a dispute in their 10K a while ago, and that caused them to miss earnings estimates, but yet they raised their guidance. So it didn't seem like, I don't own Netflix, and this is not a Netflix recommendation, but it didn't seem that the reaction in that stock was warranted if you looked a little bit deeper. And a lot of times that's what happens is stocks like that, they go down after earnings are first released. And then when people start to dig in and understand what really happened, then they come back. So there's been a couple negatives, but overall, the earnings news that I've seen has been definitely on the positive side, and it's been really good for the market.
Yeah, and here's a chart I was looking for earlier. Just shows that, like, Nasdaq no revenue stocks are up, a lot compared to everybody else. Everyone else is lagging. Profitable small mid caps that you probably want to invest in are only at 5%, but the Nasdaq no revenue stocks are up 34%. So I'm not saying this is the top, but it's a sign. And unprofitable Nasdaq, Mag 7, unprofitable small mid, they're all outperforming. So it doesn't mean that we're at the top or the peak, but I would be very cautious.
And that's something you mentioned, small caps before. And when you invest in small caps, you have to be really careful about that because depending upon what index it is, like if you look at the Russell 2000, there's a lot of those non-profitable companies that sit in the Russell 2000. If you go to the S&P small cap 600, you have making a profit is, I believe, is a requirement to be in that index. So it's a very different story depending upon what you look at. So when you're thinking about investing in a broad index, you want to understand what's in it, what makes it up. Because, like I said, the Russell, you got a lot of companies that are unprofitable. They've never been profitable, and they have very little, if any, revenues. And I know I was with another advisor of mine that's a friend of mine this morning for breakfast, and we were talking about the market and some of the companies that are in the nuclear power field that have done really well. Like Oklo is one. They don't really have revenue. They're in those companies that really don't have revenues or earnings either. So you always have to understand what it is making it up, because obviously when there's no earnings or revenues, now you're speculating because you don't know. We're hoping that company is going to be successful, but we don't know.
Yeah. Yeah, I mean, and this is what's so interesting about small caps is, small caps have been out of favor for a while, and there's reasons for that. If you think of global trade and all that, I mean, small caps tend to be more local, less international, not necessarily, but they tend to be. So the index tends to get broad stroked with certain brushes because of that, and so you think, well, tariffs, is that good or bad for local? Deglobalization, is that good or bad for local? So these questions are being posed, and the market overall has not agreed that Europe and small caps are a good place to be, except for this year. This year, Europe and actually international has done extremely well. U.S. has underperformed dramatically compared to international markets, and certainly small caps have started to catch up. I want to share this chart as a chart crime. I saw this yesterday. And it shows a chart of money market funds, total financial assets, and it just shows this huge spike in the last, I don't know, 5-7 years. And it shows, yeah, we had was that trillion, 3 trillion in money markets. And then it's spiked up in the last few years, and now it's at like 7.5 trillion. And the tweet said, look at all this money. Imagine if this starts going into the markets, what's going to happen to the prices? And I'm looking at it, I'm like, yeah, this is because they're printing money. Like, it's not because people are all in cash. I mean, if you're all in cash for the last few years, God help you. I mean, you missed a lot. And so, I look at this and say, well, that's an interesting narrative, but it's not true. They've been printing a ton of money. And when you print money, more goes into circulation, which means the numbers elevate naturally. Now, if you look at the spike, what's happened since COVID? Well, it's spiked. There's huge amounts of cash. And some goes into money markets, some goes into investments. If you're smart, you put most of it into assets, because printing cash equals asset prices going higher. And, we had CPI print. It was a little bit lower than expected, and putting that in air quotes, because it's like everyone's managing CPI like they manage earnings. Like, oh, we beat again. Like, yeah, oh, sure you did. You just put the bar on the floor so you could walk over it. Yeah, that was great. Good job. Good job. And I feel like that's going on with the CPI right now. Like, oh, the CPI underperformed what the expectations were. That means a rate cut. Yeah, I'm sure no one's managing that. Of course, there's going to be a rate cut. And so rate cut just means higher markets. I mean, if you look today, everything's up, with exception of like one or two things. Everything on my screen is green because expectations are we're ahead, and that means they're going to lower rates. Lower rates means higher asset prices to the moon, and so I struggle with this. I really do, because there's a lot of you listen to the show that are very practical people, and you're like, this is going to destroy the world. We're going to have hyperinflation, and you're not wrong. However, I'm also a capitalist, and I'm looking at this saying, well, if they're going to do it anyway, I might as well make some money. I'm not going to die in this hill. I would rather, I would rather not. I would rather take advantage of the opportunity that's given me. Even though I despise the fact that this is going on, I hate the fact they're printing money and all the stuff they're doing. I absolutely despise it, because it's destroying this country economically and financially. However, I also have a lot of clients I work with, and I need to do it in their best interest as well as mine. And that best interest is investing in assets that are going up and not investing in assets that are going down. So, don't sit here on your high horse and say, well, I don't like that. It doesn't make sense. No, make money while you can, because when things get really bad in 5 to 10 years, you're going to wish you had made more now. And there will be a time where things will get ugly, and you want to be prepared for that too. But if you don't take advantage of the markets when they're going up, you're not going to have as much when they go down. So do what you can now for yourself, for your family, for your friends. Take advantage of these markets while they're going up, because we have we've got another 3.5 years left of Trump, and he's going to do whatever he can to goose the markets higher. Take advantage of that. So
there's one thing I'd like to add about this chart, Kirk. Like, if we think about it, the market itself, from the March 2020 lows to today, it's basically tripled, because it's up 200%. So if we were to look at money market assets as a percentage of total assets, has it changed that much? No. So what we see now, yeah, that's a gross number, but you have to put it in context. And if we put it in context, it really hasn't changed all that much. There's no more money. Yes, there's more money sitting on the sidelines, but as a percentage of the assets that are out there, it probably hasn't moved all that much. Because if I look at that chart in 2020, we were at 2.5 million, and now we're at 7.5. So the market tripled, and the amount of money sitting on the sidelines tripled. So it's really the same. It hasn't changed all that much. So you have to remember to put things in context.
Yeah, wrap it up, Phil. Final thoughts here.
Sure. So I'm Phil Weiss. My firm is Apprise Wealth Management. I know experiencing big life transitions can be stressful. My job is to help empower women facing new beginnings with the financial knowledge and tools they need to make self-assured decisions. At Apprise, we'd love to get to know you. You can visit our website at apprisewealth.com. That's APPRISE wealth.com. And you can go there and read our blog or sign up for our weekly newsletter. Thanks for having me on today, Kirk. Enjoyed the conversation and have a great weekend.
Yeah. Thanks for coming on, Phil. And as we kind of wrap it up here, just keep in mind that once again, we're in a volatile month. It doesn't mean the market's good or bad. It just means we're in a kind of a holding period. So take advantage of that, and then hopefully when things. So one more context I want to say because I was thinking about this morning. The market, the weak period of the markets is typically May until October. We had a gangbuster markets for that period. The market's ahead of where it normally would be. So if the markets went sideways for the next 3 months, I wouldn't be surprised because we're so far ahead of what's normal. I'm not saying they will. I think they'll probably still go higher, but we're so far ahead of normal that if they went sideways, it wouldn't surprise me at all. But I do think next year is going to be tough. I think the second year of a presidential cycle is typically tough. I don't know if it will be, but probability wise, I would say I would err on the side of caution. But make hay while you can. As long as markets are going up, make money, and when they're going down, don't lose money. So we're gonna wrap it up this week. So that's the show for this week. Thanks again for joining us, Money Tree Investing Podcast. My name is Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth; we make your life better. You can find more about me at innovativewealth.com, and of course, you can find me every week here on the show. Please remember to subscribe to the podcast and the podcast app of your choosing. You can also check out the show at moneytreepodcast.com. On the website, you'll have access to the show notes, resources, and the archive shows. Please check out our YouTube channel. When you're there, please subscribe and leave a comment. Lastly, please leave a short rating and comment on the podcast app of your choice. Don't forget, do your own research. This show is for informational use only. We're not telling you what to think, merely how to think about investing. We're also not selling any products or services, so do not consider this advice. If you have any problems with the show, I blame Putin. Please send me an email, express your feelings. If you're seeking financial advice, talk to an oracle or a fortune teller, or maybe just a licensed financial advisor. I'm one, but as I said earlier, I'm not selling anything. But I'm easy to find. Have a great week ahead, and remember, no one will care about your money like you do. So invest in your life.